What's going on, team? It's Caddy with Money Investing. So in this video, we're going to be talking about one of the topics that I feel like is one of the biggest risks to the US economy and the markets. I really want to address this in a more balanced and objective way. This is something that I haven't really discussed in any of my previous videos, and I feel like everyone should have a really good understanding so that we're on the same page and to exactly what I'm referring to, where we are with the current situation and where can we potentially go moving forward and how it can affect the markets and the economy moving forward. So we're going to talk about exactly what that is, and then I'm going to give you guys a complete overview going over some of the details as to what that pertains. As always, if you guys enjoy this video, find it helpful, make sure that you drop a like. It really helps out with the channel. Also, make sure that you subscribe if you're new. Hit that notification bell so you don't miss out on any future market updates and videos related to investing and technical breakdowns. Also, if you'd like to join our money investing community, the Patreon link is going to be down in the description below for you guys to get access to our private Discord. We have a little bit over 1,600 members there to get access to my private trading view charts and also get access to our growth portfolio and an abundance of research, analysis, different PDFs and Excel files as well. So the thing that we're talking about today is going to be the US public debt. Now, for those of you who are not familiar with this, the US issues a lot of treasuries each year, right? We need to find a way to finance our operations, and we'll go over that in a lot of detail. But right now, you guys will notice that the US national debt, as of the time of this video, as of the minute of this video, is sitting roughly over $28 trillion. So it's not million, it's not billion, it's $28 trillion worth of US debt. And that's the national debt that the country owes to other governments around the world, other investors, and even other governments inside the country. So that's a pretty significant number. This right here is an estimate. So on this day in 2025, at current rates, this public debt will be somewhere shy of $50 trillion. So we're looking at almost a 100% increase in the US national debt at close to $50 trillion at the current levels. So first thing we're going to do is we're going to break down a report that came out very recently, like literally today, March 22nd. You'll notice that US inflation risks mount along with the debt concerns, survey shows. So reading further, you'll notice that according to economists who are also growing increasingly concerned about a corresponding surge in government debt, more than 60% of respondents polled by the National Association for Business Economics say inflation is a greater risk now than it has been in the past 2 decades. So that itself is pretty scary stuff. But even then, you guys will notice that at the same time, nearly 90% say that they are concerned about the trajectory of the public debt. So of course, public debt is a cause for concern for a lot of people out there, including our very own Jerome Powell. So back in June 2020, when he was basically at a committee, or he basically spoke in front of the Senate Banking Committee, he said that, he warned the Congress that the US federal budget has been on an unsustainable path for years. And he added that the US economy is facing a deep downturn with quote unquote significant uncertainty, right? So unsustainable path is what he said. And he basically said that the United States federal budget has been on an unsustainable path for years now. The debt is growing faster than the economy, so debt to GDP is rising. That is by definition unsustainable. And we'll go over into the debt to GDP as well and where it's trading and how it basically grew to this big to where we're trading right now and how to combat that in the future. Because right now we're looking solutions to the problem, right? This is a problem that's been growing over the past few decades now. Even since like 2007, 2008 is when we really picked up on that debt to GDP number. We'll kind of go over that in a lot of detail. But right now we're looking at solutions, right? We need to find solutions. And even Ray Dalio mentioned that this is a growing problem and we need to change our route or like our course of action in order to combat that and without having this as being a significant problem in the future. So very quickly, the national debt is a public debt and the intra-governmental debt owed by the federal government. It's also called a sovereign debt, country debt, or a government debt. It consists of 2 types of debt. The first debt is held by the public. So the government owes this to the buyers of its bonds. This is something that we have discussed in the past. It issues more capital. It issues more bonds to raise more capital to finance its day-to-day operations. Those buyers are countries' citizens, international investors, and foreign governments, right? So that's the first type of debt that the US owes, and that is going to be the buyers of its bonds that it issues and raises more capital with, right? So that's going to be the citizens, other governments, other investors, international investors, so on and so forth. The second type is going to be intra-governmental debt. The federal government owes this to other governmental departments, and it often funds government and citizens' pensions. An example is the US Social Security and retirement account. So the second one is much, much smaller because this is only going to be other government departments within the United States. The first one, the buyer of its bonds, so the public debt, is going to be much, much bigger piece of the national debt in general. So the federal government adds to the debt whenever it spends more than it receives in tax revenues. Each year's budget deficit gets added to the debt. Each budget surplus gets subtracted, right? So it's a very, very simple ledger stuff. So let's take a very simple example. Let's say right now the government deficit for the US government is going to be $100, right? So they basically owe $100 to other governments, other international investors, foreign governments, so on and so forth. Now, the only way the government actually makes money, the federal government, is through tax revenues, right? So that's the only way that they generate these tax dollars. I misspelled the tax revenue there, but you can ignore that. So tax revenue, for example, let's say in 2021, the government actually makes, let's say, $50 in tax revenue, right? That's how much it intakes in tax revenue. Now, the government also spends a lot of money, right? So that's where spending comes into play. They spend money on infrastructure, defense, healthcare, medicine, so on and so forth. And let's say that they're spending each year, let's say they spend in 2021 close to $100, right? So they spend $100, they bring in $50 in tax revenue. That is a $50 deficit for that year. And now, when that happens every year, that $50, so that negative $50 that's coming in from bringing in only 50 and spending about 100, that $50 gets added to this government deficit. And then when you add a $50 over here, now the total is going to be $150 in a government deficit, and that keeps getting mounted on top of each other, and that pile just grows, over the years. Now, of course, the way to combat that is very, very simple. You simply just spend less and you take in more money. So let's say that you spend only $25 that year, right? So in 2021, let's say instead of $100, you spend only $25 on defense, healthcare, infrastructure, so on and so forth. Now, what you have is for that year, so for 2021, what you have is called a $25 government surplus, right? So you don't have a deficit, you have a surplus, and that surplus in itself gets added back to this mountain of deficit. So we had earlier $100 deficit. So that $25 surplus gets added to this $100 deficit. And now you're only down about $75 in national debt, meaning you only have about $75 as opposed to $150, which prior, because you were spending a lot more. So of course, the way to do that is you either spend less, so that's going to be less spending, which reduces your standard of living. So of course, when you're spending less on infrastructure, healthcare, defense, your standard of living comes down, or you keep the spending as high as it is and you increase your tax revenue, right? So that's another way you can do that, is you can increase the taxes. So long-term capital gains tax, corporate taxes, there's like so many different types of taxes that you can increase. So people are going to be paying more in taxes to the government, more tax revenue. Even if you have the same spending, that will somewhat help with this government deficit or the national debt, so to speak. So moving forward, this right here are going to be the causes. Now, of course, there's a lot of causes for this. The federal government pays for things like defense, healthcare, construction. It contracts with private firms who then hire new employees. They spend their government subsidized wages on gasoline, groceries, and new clothes. That boosts the economy. The same effect occurs with the employees the federal government hires directly as well. So this right here are going to be some of the solutions that we have already gone over in a little bit of a detail. So the only way to reduce the debt is to either raise taxes or cut spending, right? Those are the only two moving parts that can help with the national debt. Either of those things can slow economic growth. They are two of the tools of contractionary fiscal policy, right? So all of this kind of comes into fiscal policy. This has nothing to do with Jerome Powell or monetary policy, because monetary policy is more focused on the GDP growth, unemployment, interest rates. Fiscal policy is more about taxes and spending, so to speak. So cutting spending has pitfalls. So government spending is a component of GDP. If the government cuts spending too much, economic growth will slow. So of course, if we kind of reduce that spending, reduce that liquidity, that's going to slow down the economy. That leads to lower revenues and a larger deficit. The best solution is to cut spending on areas that do not create many jobs. Now, tax increases beyond the 50% bracket can also slow growth. The industries or groups that pay higher taxes will get angry, so it's very human psychology. Politically, they often end a politician's career, so we're not going to get into that, but that's why the US debt will be never paid off, is what they say, according to the levels that we have reached right now at close to $28 trillion. Now, most governments can safely finance their deficit instead of balancing their budget. Government bonds finance the deficit, so we know that the government issues treasuries, 10-year, 30-year, long-dated treasuries in order to finance their operations by raising that capital as long as the debt is below the tipping point and creditors believe, again, a very, very important terminology here, the creditors believe the government will repay them back. So what we're reading here is as long as there's demand for government debt, as long as there's demand for US debt and creditors believe that the government will repay them back, government bonds remain more attractive than riskier corporate bonds. When debt is moderate, government interest rates can remain low, and that allows government to keep running deficits for years. Meaning, as long as there's demand for US government debt, they can run this deficit for years to come because there's always going to be a way to finance all these deficits. Now, moving forward, you guys will notice how moderate increases in debt will boost economic growth, but too much debt increases growth too fast. If growth is faster than the ideal range of 2 to 3%, it can create a boom which leads to a bust. And ever-increasing national debt slowly dampens growth over the long term, and debt holders know in the back of their minds that it must be repaid one day. They demand larger interest payments. They want compensation for an increasing risk that they won't be repaid. The Congressional Budget Office found that a 1% increase in the debt raises interest rates by 2 to 3 points. That slows the economy because businesses borrow less. It creates for a less desirable growth opportunity or an environment, and they don't have the funds to expand or hire new workers. That reduces demand as people shop less. Firms slash prices and they make less money. They lay off workers. Interest rates continue to rise. It can cause a recession. So it does have very, very ripple effects as to what this debt can do to the economy and the markets. Now, investors compare the debt to the nation's ability to pay it off. So the debt to GDP ratio does just that, right? It divides the debt by the nation's gross domestic product, so the national GDP, and that's everything the country can produce in a year. Investors worry about default when the debt to GDP ratio is greater than 77%. That's the tipping point according to a study by the World Bank. It found that if the debt to GDP ratio exceeds 77% for an extended period of time, it slows economic growth. The tipping point for emerging market countries is 64%, so slightly lower than a developed country. And if the debt to GDP ratio is higher, it will slow growth by 0.02 percentage points each year. So remember, 77% is what the tipping point is according to the World Bank. And this right here, again, is going to be the current debt levels. It has been coming down slightly. So as of, let's take a look. So as of March 15th, it was just over 28 trillion. It did come down to 27.9 trillion, but I just got that screenshot from the US debt clock, like literally 10 minutes before I started recording. So that $28 trillion is what we're looking at. And this right here is going to be a pretty good sort of drawback or historical sort of levels for the debt level. So this right here is going to be the debt. And this right here is going to be the debt to GDP. So this is going to be debt to GDP over here. So you'll notice how we were hovering around 30%, 33%, 32% back in 1979, 1980, 34%, 38%, 39%, 40, 46, 48% back in 1987. So very, very reasonable levels at back 20, 30 years for the debt to GDP levels. Come, say, let's say 1997, 1998, like the years when I was born, you'll notice 65, 65%, 63%, coming down to 59%, 55%, 55%, quite reasonable levels still. So we're not over that tipping point. And while the debt is growing to 5.2 trillion, 5.4 trillion, 5.5 trillion, so still a pretty substantial amount if you think about the debt to GDP ratio. This right here is going to be anything 2007 past. So 2007 comes around. We've got the global recession. We've got the housing bubble crash. You know, it was a pretty significant crash for the markets as well. 68%, 82%, and then 2010, boom, all the way to 91%. And government debt grows to $13.5 trillion, 95%, 99%, 100%. And right now we're sitting at 136%. And the current national debt, of course, is sitting roughly at 26 to 28 trillion dollars as of 2020. Now, of course, in 2021, that's expected to grow even further. So what does that tell us about the future, right? This is the only thing that kind of is a little bit of a cause for concern for myself, right? Which is why every time interest rates, inflation, every time those fears kind of come into the markets, I see that as a really good buying opportunity. But this right here is something that really concerns me over the long-term growth potential for the economy, for the GDP, and of course, for spending, investing, and for the markets in general. So I want you guys to comment your thoughts below as well, right? What do you guys think about this? What are your thoughts about the current national debt? What are your thoughts about the current debt to GDP ratios? What are your thoughts about this whole situation? And how do you see us combating this and getting out of this big problem, right? Because it does have many ripple effects, and it's not easy, right? It's not easy to run a country. It's not easy to run an economy because there's so many moving parts from both the fiscal and monetary policy standpoint. So it's incredibly challenging. Like, this is beyond my pay grade, and my knowledge base is to really understand all and every effects of slightest movements and slightest changes in interest rates, spending, taxes, so on and so forth, and how that's going to ripple into the economy and how it's going to affect a lot of different pockets of the markets and investing in general, right? So let me know in the comment section down below. The more people working on this problem, the better it is, so that we can combat and find a solution over the long term. So this right here is basically saying that the national debt is so large, it's hard to imagine. Here are 3 ways to visualize it. And first, more than $82,000 for every man, woman, and child in the United States is how much that debt represents. So $27 trillion divided by the population of 328 million people. Now that's more than double the US per capita income of about $32,000. Second, it's the largest sovereign debt in the world. So, right, this right here is going to be the second one, which is basically saying that it's the largest sovereign debt in the world. It's slightly greater than that of the European Union, which consists of 27 countries. Third, the debt is more than a country produces in a year, right? So that right there is what Jerome Powell mentioned as significantly uncertain or unsustainable by definition, is because the debt is growing at a much faster rate and it's much bigger than the GDP or the economy of the United States. Fortunately, investors still have confidence in the power of the US economy. So again, foreign investors like China and Japan keep buying treasuries as a safe investment. That keeps interest rates low. And if that were ever faltered, interest rates would skyrocket. A weak demand for treasury notes drives up interest rates. That's why Congress did so much damage when it threatened to default on the US debt. So moving forward, you guys will notice how Ray Dalio mentioned that if you look at history, for example, the Dutch Empire, the British Empire, both experienced the creation of debt and the printing of money, less educational advantages, greater internal wealth conflict, greater challenges from rival countries, and every country has stress tests. If you look at the British history, the development of rival countries led them to lose their competitive advantages, right? Their finances were bad because they had accumulated a lot of debt. So after World War II, those trends went against them. And then they had the Suez Canal incident and they were no longer a world power, and the British pound is no longer a reserve currency. He goes on by further saying that these diseases almost always play out the same way. The United States' relative position in the world, which is dominant in almost all these categories at the beginning of this world order in 1945, has declined and is exhibiting real signs that should raise worries. There's a lot of baggage, and the US has a lot of debt, which is adding to the hurdles that typically drag an economy down. So in order to succeed, you have to do a pretty big debt restructuring, is what Ray Dalio mentioned towards the end. So again, finding a solution to the problem is going to be very important. And he basically has a quote saying that the United States is a 75-year-old empire and it's exhibiting signs of decline. Wealth cannot be created by creating debt and money. So again, I thought that was pretty interesting stuff. Again, I'm trying to give you guys a balanced, objective overview of what the debt situation looks like, just so we're not blindsided by this in the future and everyone has a really good understanding. We're all on the same page as to what can be done, what affects the public debt, and how can we solve this problem moving forward. All right, guys, so in my strong opinion, when it comes to the GDP and the total national debt for the US, the only time it becomes a problem, and this is not a short-term problem, right? This is more of a longer-term problem. This is not going to be an issue, in my strong opinion, at least for the next 5, maybe 10, maybe 15, 20 years. So this is far out into the future, but I still wanted to address this just so we're all on the same page and we can kind of benefit from this knowledge and kind of benefit from the idea on how we can combat this problem moving forward. Now, there's been a lot of countries in the world that have actually been in a situation where their debt to GDP ratios have been less than 50% and they've still struggled to grow their economy. And there's also been countries whose debt to GDP ratios have also gone up to over 200% and they've still done incredibly well. So that just metric is not a huge cause for concern. It's still something that we need to look at Personally, I only want the US GDP debt to ratio to kind of stabilize a little bit, and this obviously cannot persist indefinitely for the debt to continue to run higher than the global domestic or the gross domestic product for the US economy. So I would want that to come in control, and less than 100% would be ideal for the US economy. The only time I see that being a problem is when the demand for the US debt kind of slows down and starts declining, and when interest rates start picking back up. That's the only time I personally feel that there's going to be a problem or an issue over the long term for the US economy, because then you get into a trajectory where the central bank or the Fed needs to print more money to buy more bonds and finance that US debt moving forward, and that's what's going to lead to more money supply, hence a more depreciating US dollar in the future. And that's again going to be more so towards the longer term. This is not a short term or a near term problem. This is something that we will discuss in later videos as well. And definitely make sure that you drop a comment to let us know what your take is. What do you guys think about this growing national debt and the deficit that we have each year because of higher spending and lower tax revenue, so to speak? So let me know in the comment section down below, what do you guys think? Again, if you guys enjoyed this video, found it helpful, make sure that you drop a like. It really helps out with the channel. Also, make sure that you subscribe if you're new, hit that notification bell. Check out the Patreon link down in the description below. As always, happy investing, and I will see you guys in the next video.